Hello and welcome to the monthly market report for February 2022. My name is Darling Medranda with eXp Realty, and today I'm going to be walking you through three of the most important topics in the housing market right now. We'll be talking about homeownership as a hedge against inflation, raising mortgage rates, and the latest update that we have on forbearance. So I'm going to begin with the first topic, homeownership as a hedge against inflation. Now, why is this so important to be talking about? Well, as we see prices rise around us, at the gas pump, at the grocery store, homeownership is certainly not immune to that in any way. And neither is raising rent. I want to begin with a quote first from Investopedia. It says, real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So what we can see here is that homeownership is one of those things that you can lock in the cost today. So let's take a look at this slide here. This is homeownership as a hedge against inflation, and I want to break it down for you so you can really see what we are talking about here. This is home price appreciation versus the consumer price increases over the decades. And it goes all the way back to the 1970s. Now, what you're looking at here is the blue bars, is the average inflation rate for the decade, and the green bars are the average home price appreciation for each of those decades as well. Let's look at the 1970s to start. Inflation increased at 7.1% in that decade, and home values appreciated at 9.9% in the same time period. So, home ownership outperform inflation. And where do you want to be in inflationary times? In that asset that's outperforming inflation. Now, in the 1980s, it was a little bit more balanced. 5.6% inflation, 5.5% home price appreciation, and look at the 90s. We start to see home values tick up again a little bit more, outperforming inflation throughout that decade. Now, we know that 2000s were very different. Home prices perform at a very different rate than what we have seen in many other decades, and even we are seeing today and potentially tomorrow. We also have a fundamentally different housing market. We had the oversupply of homes. We had, lending standards that were vastly different than they are today. Homeowners didn't have the equity that they have in their homes right now. So fundamentally, a different market where we are not headed going forward. Home prices did not outperform inflation in the 20s, but look at the 2010s. This is where home values really started to kick in. Homes started appreciation much faster than inflation, 4.9% to 1.8%, and then 2020 and 2021. You know what happens here? Massive home price appreciation, a drastic difference where home values outperform inflation. So over the time, what you can see is that homeownership is generally looked at this great hedge against inflation because home values are performing better than the inflation rate. That means that someone buying a home today can lock in today's cost and protect themselves against the rising cost of inflation in that biggest monthly payment going forward. Now, this becomes really important when we start to talk about renting, because renting takes on the risks of raising rental prices after year after year after year. Let me share a quote with you here that's really powerful for renters. This is from Bankrate, and it says, a fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will raise and other expenses might creep up, but your monthly housing payment remains the same. That's certainly not the case if you are renting, and that's because rental prices raise year after year. And so this becomes really powerful for someone who might be sitting here going like, I could buy today, I'm going to kind of press pause, and I'm going to wait. I'm going to wait and see what happens to home values. If they drop, if they raise, well, all the forecasts that we have seen show that home values are projected to continue raising. We also know that mortgage rates are projected to keep raising, and we know that rental prices are raising. So what does that mean at the end of the day? Someone who continues to rent but could buy is taking on additional increases in rent year after year. Plus, it's going to cost more to buy a home down the road. So, really important for renters to understand this dynamic, and I think the next slide will help you to show you rental prices compared to inflation rates. This shows that rent increase has been greater than inflation in most years. So let me break it down again. Rental price appreciation versus core inflation rates, again, going all the way back to the 70s. So your blue line is that core inflation rate, and your green line is rental price appreciation. And what do we see on the whole? The green line higher than the blue line in most scenarios, meaning that rental prices have increased at a faster rate than inflation in most times. Yes, there's some ticks down below the blue line. However, that means it's more expensive to rent over time because rental prices are continuing to rise faster than the rate of inflation. So when we have this conversation with renters, it becomes mission critical that they understand the dynamic of buying now, if they can, to avoid those increasing costs for rent and inflation all around us. So let me go ahead and share this quote. This is from Forbes. Homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what's happening in the market. You're locking in that payment at today's cost. Tangible assets like real estate get more valuable over time. You have seen that in the graph and the data that I have shown you, which makes buying a home a good way to spend your money during inflation times. You know, we have talked about a lot of home prices appreciation, and I'm sure you want to know where is that headed as we have this conversation and we think about raising prices and how homes aren't immune to that. That's for certain. So let's take a look at this next graph from the Home Price Expectation Survey, and I think that gives you a real clear picture of where the home prices are projected to head according to the home experts. Now, the Home Price Expectation Survey is a survey of 100 economists, data analysis, people who are projecting out home price appreciation, and in the fourth quarter of last year, this is the projection for house appreciation by 2026. So what we are looking at, they divided out the group into optimism and pessimism. Optimism being the ones projecting the most appreciation over the next appreciation over the next 5 years, and pessimism estimating on the lower side. So take a look at the orange bar. Those are pessimists. You know, the experts that are saying home price appreciation on the lower side cumulatively for 2026 is going to be over 23%. So, as experts look forward, the condition of the market, what's projected to happen? Home values are projected to increase in value over time. Even on the lower end, 23%, 23.7 is pretty significant over the next 5 years. So locking in today's cost is mission critical for those who have the opportunity to do so, to protect themselves in their largest monthly payment, because as we know, with home prices rising, mortgage rates rising, inflation all around us, it's going to get more expensive to purchase a home. Let's talk a little bit about mortgage rates. Here we are at the beginning of February, and certainly we have seen a rise in mortgage rates in a volatile environment. So I'm going to cover where we are today, but certainly as we go through the month, I'm going to keep you updated on what's happening with mortgage rates. So let's start right here. Sam Cather from Freddie Mac says, mortgage rates remain unchanged from last week. The economy lost momentum in January, leaving mortgage rates unchanged from last week and relative flat for over a third consecutive week. This stagnation reflects the economic impact of the Omicron variant of COVID-19, which we believe will subside in the coming months. As economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that homeowners' demand continues to be elevated as supplies remains low, driving higher home prices. Expect to see rates go up. We are about 3.55% on the average 30-year fix. It's recorded by Freddie Mac, but no doubt a volatile January leading into February that I believe we'll see more raise in rates, and that's what we need to be prepared for. So if we look at this raise in rates, we are at about 3.55%. This graphic goes back to the beginning of 2020, and we are starting to get back in the area where we started when the pandemic came on us in March of 2020. Just to put that in perspective, the Fed comes in, they influence. They don't control the mortgage rates, but they influence the rates down, and now we are coming back up. Certainly a sign that we can all hope for, that the economy is improving, that we are getting through this and we are moving ahead. If you take a little bit larger look, if you go back to the beginning of 2018, which is what this graphic shows on the average 30-year fixed, and sort of make this line of 3.55%, you can see where we sit there, right? Certainly we are higher back in 2018, and 2019 started to come down and certainly drop to historic lows during the pandemic, and we're starting to go back out that. Freddie Mac says, as mortgage rates raise, we do expect some moderation of housing demand, causing house price growth to temper. However, the combination of the large number of entry-level homeowners facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. No doubt we will see a housing market that is competitive this year. It goes on to say, in 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, while refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. Why is this important? Look at the two mortgage markets. You have the purchase market, you have the refinance market. Purchase market forecasted to grow, refinance market forecasted to constrict. And that makes sense, right? In a racing environment, everybody has the chance. Maybe not everybody. There still will be refinances, but most people refinance at a record low rate, and good for them as a homeowners to be able to do that. But we are going to see volume constrict. Purchase market is going to grow. Refinance market is going to constrict. Let's keep that in perspective as we go into the year. You know, if you take this rate of 3.55%, even going into 4%, which I think we will see very soon, that's a still very, very favorable rate when you go back in the way to the 70s. This is the average 30 years fixed by decade, going to the 70s, 80s, 90s, 2000s, 2010. And what do you see there at 3.55% or even at 4%? Very, very favorable financing when you look historically. Between 2010 and 2020, we bounced around 3.5 to 5% was really the range of interest rates during that time. You see the average rate here of 2010 of that decade, 4.09%. Very, very good financing. So it's going to feel like we are heading higher, but when we look historically, we are still very, very good financing for homes across the country. You know, many are asked about interest rates and they might not have an opinion on it and say, well, they're going to go higher and we are going to have to wait and see. This is the 10-year Treasury Yield. This is a look at the 10-year Treasury going back to the beginning of December. During that time, the rate on the 10-year Treasury yields has a skyrocket, knowing on the door right now of 2%. Why is this so important? Here is why it's so important. For the last 50 years of relationship between the mortgage rates and the 10-year Treasury yield has been almost symbolic. Whether the 10-year Treasury yield goes, there goes the 30-year fixed rate, okay? The Fed. And the Fed raising rates does not control interest rate. It can only hope to influence it. What we want to watch is the 10-year Treasury yield. Why is that? Because over the past 50 years, there's been a relationship between the 10-year Treasury and the 30-year fixed. You know, even to take this a step further, what I will do is I will look at where we started the year at about 3.1%, where we are at right now at 3.5%, and where we're going, 4%. And I am not saying we are going to stop at 4%. I don't have a crystal ball, but that's certainly the outlook. Rates hit the highest level since March 2020, leading to the slowest pace in refinance activity in over 2 years. You know the market. In the last few years, the mortgage market certainly has had a ton of refinances in it. Those are going away. And my advice to you is to have a great partnership with a lender and an agent. Now, the next topic, the last one I'm going to walk you through today, is our latest update on forbearance. This is something we have been following along with for a while, and sharing with you, and today's data is really going to help you articulate why we will not see a wave of foreclosures coming into the market. Now, I want to begin today with an update on how many loans are in forbearance program. Loans in forbearance have fallen below 1 million. This is massive. We are at roughly 780,000 loans in forbearance today, and that equates to only about 1.4%. If you think about where we started, over there on the red bars on the left, there were nearly 5 million homes in the forbearance plan in May of 2020, and we are down to about 780,000. So huge progress, and just one more way that shows that the forbearance program has really helped homeowners change their situations, starting their homes, and really be in a better place that they would have been in such a time of economic uncertainty. And this is vastly different than what we saw in 2008. So I want to share a quote with you from Black Knight that says, "As the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans." So many people, 89% of the people who went into the forbearance plans have exited, and that is massive, massive improvement. I want to share today this graph showing the loans upon exiting the forbearance program. I want to break this down because this really walks you through what's happening as people are exiting the program today. So let's take a look at the green section. 38.1% of homeowners exiting the forbearance plan are paid in full. So they have made their monthly payments, or they have paid off their loan. They have done something to bring their payments current, and they are in a great place. They are walking away, no issue. Now 43.7% are workouts or repayment plans. That's the section in blue. This is the game-changing section. This is the section we didn't have last time around when housing bubble burst, because these are the homeowners who have been able to make a modification and work with their bank or their lender to change their situation and stay in their homes. This is huge. This blue section is getting a little bit bigger than the green section, and that's because more and more people have been able to go back and work out an alternate plan. Now, the percentage of homeowners that are still in trouble are in the orange section, 18.2%. What this does mean is that those homeowners are exiting the plan without a loss mitigation plan, but on the safe side. What we know from Black Knight is that 93% of homeowners in the forbearance plan have at least 10% equity. So when you have that equity, you also have the opportunity to potentially sell your home rather than go into forbearance. So people sitting in this situation, 10% is kind of that tipping point in selling their house. They could pay off their fees. They could maybe even walk away with a little cash in their pocket if they sell their home. We have a very strong equity situation across the country right now, enabling that opportunity. So as we look at this graph and we think about how many homeowners are exiting the plan, the reality is that about 4 out of 5 homeowners are walking away just fine. Now, where I want to bring some additional context to this is on the forbearance situation, or what the forbearance situation looks like in a typical year in the US, because I think this is going to start to shape up what we are talking about today versus what we have in 2008. 9.3 million homes went into foreclosure the last time around when the housing bubble burst, and we are in a really different situation right now. What this says here is that 422,360 fewer foreclosures over the last year. So we have significantly fewer foreclosures today than we will even in a normal year. Let me break it down for you. So look at those first 3 red bars. The taller ones on the left, that's 2017, 2018, and 2019. The number of foreclosures we had in those normal years leading up to the pandemic averaged just under 300,000. And so the unfortunate reality is that in this country, every year there are homeowners who do not go into the foreclosure process. In 2017 throughout 2019, that number averaged out to about 290,000. Now, if you look at the 2020 and 2021, these were not normal years. This is where the forbearance program came into play, and there were far fewer foreclosures in each of those years. So If you look at the red bar under the 2020, there were 120,000 foreclosures in 2020. That was short 161,000 of what would be normal. 2021 through the third quarter is what I have data for right now, 29,000, so massively short. So that's where that 422,360 number comes from, and contextually, if you think about that, that is incredibly low. Foreclosure activity is actually at an all-time low. So look at the number over the right side of the screen, 2021. Where we are so far, there are 151,000 foreclosure filings. Now, we never want any homeowner to go through the foreclosure process. We certainly don't want that to happen. I believe in homeownership and the value that brings to everyone. But if you put this into context and you look at those red bars, 2007 to 2015, millions of homeowners were going into this foreclosure process, and that is vastly different from where we are today. Even in this number of 151,000, if it doubles, if it triples, if it quadruples, keeps going, we are nowhere near where we were when the housing bubble burst. And this is massive, impactful, showing that the fundamentals of today's market are just very, very different today. Now, I want to end with this quote, because I think it really kind of brings it home. This is from CoreLogic. We might see a little bit of an uptick in foreclosure rates in 2022, just an uptick though from an extraordinarily low level. We're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low. That's exactly where we are today. You know, the numbers of homes going into foreclosure process. Nothing like we saw in the housing crisis. Thanks to the forbearance program that gave homeowners the mortgage relief that they needed when they needed most. I hope you enjoyed today's market update. Be sure to check me next month, and don't forget to follow me on social media. My name is Darling Medranda, your local realtor with eXp Realty in Long Island, New York. Thanks for watching.